In this video, I am going to discuss about exchange rate risks. Let's recap our knowledge about forex market and exchange rates because we discussed about these topics in early videos. The forex market, also known as the foreign exchange market, is where currencies from different countries are traded. The exchange rate is the price at which one currency can be exchanged for another. The value of a currency can fluctuate based on various factors, including economic and political events, supply and demand, and interest rates. We discussed about different types of exchange rates indications. All these types are indicating the same exchange rate between US dollar and euro. This is the most common and standard way of indicating the exchange rates. And we discussed about spread. This is the difference between the buying rate and the selling rate. Always remember you will get the lowest rate when it comes to exchange rates. Bank or the exchange broker will get the highest rate. Let's say if you want to buy 1 US dollar, you will have to pay the highest rate, which is this 1.2 euros. If you want to sell 1 US dollar, you will get this price, which is the lowest price, 1.1 euro. The difference between these two values are called the spread. This is the profit that the bank or the currency exchange will earn on the foreign exchange transactions. Now let's discuss about fixed versus floating exchange rates. Fixed exchange rate is where the value of a currency is set and maintained by the government or central bank. Under this system, the government or central bank will actively intervene in the foreign exchange market to ensure that the exchange rate remains stable and within a certain range. This can provide stability and predictability for businesses and investors, but can also be more difficult to sustain in the long term. This is where the government or the central bank will actively intervene in the forex market. Floating exchange rates are a type of exchange rate regime where the value of a currency is allowed to fluctuate freely based on market forces such as supply and demand. In this system, the government or central bank does not actively intervene to control the value of their currency. This allows the exchange rate to adjust automatically to changes in the economy and helps to promote international trade and investment. This is where the exchange rates are free to fluctuate. Supply and the demand for foreign currencies will determine the exchange rates. Dirty floating. Dirty floating is a type of exchange rate regime where the exchange rate is allowed to fluctuate, but the government or central bank may intervene from time to time to influence the exchange rate. This intervention can take the form of buying or selling currencies in the foreign exchange market to influence the exchange rate. Dirty floating is between the fixed exchange rate and the floating exchange rate because it is free to fluctuate, but time to time the government or the central bank will intervene. Now let's discuss about factors affecting the demand for foreign currency. Interest rates. Higher interest rates tend to increase demand for currency as investors are attracted to higher returns on their investment. Economic performance. A country with a strong growing economy is likely to attract more investment, which can increase demand for its currency. Political stability. Political instability can lead to uncertainty and risk, which can reduce demand for a country's currency. Inflation rates. High inflation rates can reduce the purchasing power of a currency, which can lead to decreased demand. Trade balances. A country with a trade surplus, which means exporting more than its imports, is likely to have increased demand for its currency, while a country with a trade deficit, which means importing more than its exports, may have reduced demand for its currency. Speculation. The expectations and predictions of market participants can also influence the demand for a currency, as investors may buy or sell a currency based on their beliefs about its future value. Imports. Imports can also affect the demand for a currency. If a currency imports more than it exports, it will need to buy foreign currencies to pay for their imports. This can increase the demand for foreign currencies and reduce the demand for the country's own currency. Now let's discuss about factors affecting the supply of foreign currency. Exports. A country that exports more than it imports will earn foreign currency, which increases its supply. Conversely, a country that imports more than it exports will need to sell its own currency to buy foreign currency, which can increase the supply of its own currency. Foreign investment. When foreign investors invest in a country, they often need to buy the country's currency to make their investments. This can increase the supply of foreign currency. Interest rates. Higher interest rates in a currency can attract foreign investors who may need to buy the country's currency to make their investments. This can increase the supply of foreign currency. Political stability. Countries with stable political systems are generally more attractive to foreign investors, which can increase the supply of foreign currency. Government policy. Governments may buy or sell foreign currency to influence the exchange rate. For example, a government may sell foreign currency to increase the supply of its own currency and reduce its value relative to other currencies. Speculation. The expectations and predictions of market participants can also influence the supply of foreign currency, as investors may buy or sell a currency based on their beliefs about its future value. This can affect the supply of foreign currency in the short term. Now let's discuss about euro currency. Very important thing to note that we are not discussing about the currency of euro, which is the currency used in Europe. This is the euro currency. Euro currency. These are two words. Here we are discussing about euro currency. This is a term which is a one word. Here the euro denotes the foreign currency. So the euro currency means foreign currency. Do not get confused with the currency of Europe. We are talking about the foreign currency. So euro currency refers to any currency that is deposited in a bank outside of its country of origin. For example, if a US dollar deposit is made in a bank located in the UK, it would be considered a euro currency deposit because US dollar is the currency of USA, not in the UK. So when the US dollar deposit is made in the bank located in the UK, this will be a foreign currency to UK. So this will be considered as a euro currency deposit. Euro currency deposits are usually made in major currencies such as the US dollar, euro, Japanese yen or British pound. Euro currency deposits can be used for international trade and investment and can also be a source of short-term financing for banks and corporations. The euro currency market is a large and important part of the global financial system. You have to have the understanding of why euro currency is exist. It is because to facilitate international trade and investment, and this will be used as a short-term financing. Now let's discuss about euro credit. As I said earlier, we are not discussing about the currency of euro. Here the euro denotes the foreign. So this will be the foreign credit market. The euro credit market refers to the market for loans denominated in a currency other than the currency of the country where the borrower is located. The euro credit market allows borrowers to obtain financing in a foreign currency, often at a lower cost than it would be available in their own currency. The market is dominated by large international banks that act as intermediaries. Now we know what is an intermediary. Lending funds that they have raised from depositors or other investors. The euro credit market can be used by governments, corporations, and individuals to obtain financing for medium term for a variety of purposes, including trade, investment, and infrastructure projects. So, the euro credit market is used for medium term financing. Now, let's discuss about euro bond. Here also, euro denotes the foreign. So, this will be foreign bond. A euro bond is a bond that is issued in a currency different from the currency of the country where the bond is issued. For example, a euro bond issued by a US company may be denominated in euros or Japanese yen. Euro bonds are typically issued by large multinational corporations, financial institutions, and governments, and are sold to investors around the world. Eurobonds offer several benefits, including the ability to access funding from a wider pool of investors and the ability to raise long term funds. This is important, long term funds at a lower cost than may be available in the borrower's home currency. Eurobonds are traded in international capital markets and are subject to fluctuations in interest rates and currency exchange rates. Now let's discuss about exchange rate risks. Exchange rate risk refers to the risk of an investment's value changing due to the changes in the exchange rate between two currencies. Exchange rate risk can impact a wide range of investments, including foreign currency, stocks, bonds. There are three types of exchange rate risks: economic risk, translation risk, transaction risk. Let's discuss about the economic risk first. This refers to the risk of changes in the overall economic environment of a country that may affect the value of investments in that country. For example, if a US based company invested in a factory in Asia, changes in Asian countries' economic policies, such as tax rates or tariffs, could impact the profitability of the investment. Economic risk can be difficult to predict and manage as it is influenced by a wide range of factors, including political instability, natural disasters, and changes in global trade policies. Now let's discuss about the second type of exchange rate risks, translation risk. This refers to the risk of changes in the value of foreign assets and liabilities when they are translated into the reporting currency of a company. For an example, US based company has a subsidiary in Canada. Subsidiary means the USA company owns another company. Now this company is located in Canada and the subsidiaries financial statements are denominated in Canadian dollars. Because this company is located in Canada, so they prepare their financial statements in Canadian dollars. At the end of the year, the subsidiaries' financial statements show 1 million Canadian dollars in assets and half a million Canadian dollars in liabilities. Exchange rate between Canadian dollars and US dollars changes from 1 Canadian dollar equals to 0.75 US dollars at the beginning of the year to 1 Canadian dollar equals to zero point 0.7 US dollars at the end of the year. The exchange rate has changed. When the US based parent company consolidates the subsidiaries' financial statements into its own financial statements, it must convert the Canadian dollar amounts into US dollar amounts at the current exchange rate. Using the end of year exchange rate of 1 Canadian dollar equals to zero point 0.7 US dollars, the subsidiaries 1 million Canadian dollars in assets would be translated into 700,000 US dollars and its half a million Canadian dollars in liabilities would be translated into 350,000 US dollars. This means that the subsidiaries' net assets in US dollars would be 350,000, which is lower than the 375,000 net assets. Net assets it would have had if the exchange rate had remained at 1 Canadian dollar equals to 0.75 US dollars, which means the changes of exchange rates will affect the year-end translation of the financial assets and liabilities. This is the third exchange rate risk, transaction risk. This refers to the risk of changes in the exchange rate between two currencies during the time it takes to complete a transaction. For an example, if a US based company sells goods to a customer in Japan and agrees to receive payments in Japanese yen, the company is exposed to transaction risk if the exchange rate between the US dollar and Japanese yen changes before the payment is received. Between this time period, the exchange rate can be changed. This can impact the profitability of the transaction and may require the company to engage in hedging strategies to manage the risk. We can reduce the transaction risks using internal hedging and external hedging techniques. You have to remember that we cannot reduce the economic and translation risks using these methods. Only the transaction risks will be reduced using internal and external hedging techniques. First, let's talk about the internal hedging techniques for transaction risk. Matching. Matching involves matching cash inflows and outflows in the same currency to reduce exposure to foreign exchange risk. For example, a company with foreign currency denominated receivables can match them with foreign currency denominated payables, reducing the risk of exchange rate fluctuations. Which means, let's say there is a company B. They are importing raw materials from country C, and also B is exporting their finished goods to country C. So what these two companies can do is they can match the inflows and outflows of currencies so that the transaction risk will be reduced. Leading and lagging. This involves deliberately delaying or accelerating foreign currency payments or receipts to take advantage of expected exchange rate movements. For example, a company may delay payment of a foreign currency invoice if it expects the exchange rate to improve in the near future. Counter trading. This involves trading goods or services in exchange for other goods or services rather than using cash. This can be useful for companies that want to reduce their exposure to foreign exchange risk by avoiding currency transactions altogether. Here, companies are exchanging goods and services without having to use the currencies. Netting. This involves offsetting foreign currency receivables and payables to reduce the amount of currency that needs to be exchanged. This can be useful for companies with a high volume of foreign currency transactions. Here, the companies calculate the net amount, which is an inflow or an outflow based on their receivables and payables, and only pay the net amount or only receive the net amount. This will reduce the transaction risk. Paying in local currency. This involves negotiating with foreign suppliers or customers to pay in their local currency rather than in the company's home currency. This can be useful for companies that want to reduce their exposure to foreign exchange risk and avoid foreign currency transaction costs. Now let's discuss about the external hedging techniques for transaction risk. We discussed about these techniques in early video under interest rate risk. There we discussed about the forward contracts, options and future contracts in the context of interest rate. The same theories and principles are used here as well for exchange rate risks. Forward contracts. This involves entering into a contract to buy or sell a specific amount of currency at a predetermined exchange rate at a future date. This can help companies and investors lock in a favorable exchange rate and protect against unfavorable exchange rate movements. This is an obligation, which means you have to exercise these contracts and these are customizable. And these contracts cannot be traded on exchange. Options. Similar to forward contracts, options allow companies and investors to lock in a favorable exchange rate. However, with options, they have the option to exercise or not to exercise the contract depending on the exchange rate movements. This is not an obligation because the companies have the option to exercise the contract or not to exercise the contract, which is why these are called the options. Futures contracts. Futures contracts are similar to forward contracts but are traded on exchanges. They involve an agreement to buy or sell a specific amount of currency at a future date at a predetermined price. These are non-customizable and can be traded on exchanges. Thank you for watching. See you in the next video.